Nick Paulson, Country Head and Strategies with Espirito Santo, joins us live now. Nick, good to have you on ET Now. Thank you for joining us. What do you want to react to? What do you want to start with? Ben Bernanke, diesel price hike, or the fact that Indian markets are moving from strength to strength irrespective of the fundamental turf?
I think I agree with you that the more important point for India is the diesel price hike. I think it's a very positive step. The key now is, does the government roll back or not? We've seen this before where there's an initial positive step which is then rolled back, but I think if this hadn't happened, a ratings downgrade was near inevitable. If you look at the first 4 months of the year, I think it was 51% of budgeted expenditure and only 17% of budgeted revenues coming in. So the fiscal situation was looking critical. We were thinking it could be as bad as 5.8% instead of the targeted 5.1%. So I think that's good news, and let's watch in the next few days as the campaign against it from TMC starts and see if the government can hold firm.
Right. So Nick, based on the kind of communication we've got from US Fed last night, are you of the view that in the near term global asset prices, they will continue to appreciate because of this global liquidity party, and in the near term one should align with strength rather than trying to identify spots of weakness?
Yeah, I think in the near term, I mean, the pattern of QE has always been, it's good for it's weak dollar, strong for emerging market currencies, good for emerging market flows, and very strong in terms of commodities. So I think a combination of effectively unlimited QE, well, it's QEX rather than QE3. It's an ongoing quantitative easing program. It's $40 billion a month, but it's also, if you combine it with twist, you're looking at $85 billion a month until the end of the year. So it's substantial. So I think in the near term, it's positive, but I think I'd be cautious on, in the near term, I think it would be good for India, but India's not an obvious QE play. India's Achilles heel in QE is commodities, and specifically oil. When QE1 started, oil was just above $40. Oil's now $116. So it's not good for either. Obviously, it's bad for inflation, and it's bad for the fiscal deficit. And generally, I think it's more ambiguous, the effects of QE since QE1. QE2 wasn't particularly good for flows or for Indian markets, and domestic factors took over. So I don't think QE3 should be deemed in the medium to long term a major factor driving portfolio decisions for India. I think it'll give a short-term fillip to the market, and it'll probably help the rupee.
Nick, just going back to the point that you were earlier making, will a dovish stance by Bernanke actually help salvage A, the US economy, and B, how long will the rally in equities also last thereby?
Well, I think in terms of the US economy, I think Ben Bernanke's clearly saying that whilst growth is okay, it's not good enough to drive the kind of employment growth he wants. And he's also clearly very worried about the fiscal cliff coming up at the end of the year. But I think QE1 was enough to turn the tide. It was much more substantial than any other of the QEs we've seen since. But it's clearly having a declining impact on the fundamentals in terms of output and in terms of employment growth within the US. And I think it comes with a lot of issues. If you think about the risks to QE, I think the question of, it's increasingly politicized. Obviously, the Republicans have been opposed to this, particularly Paul Ryan. There's a question mark, what happens when the economy comes off this? This is a patient on unconventional medicine in perpetuity. What's going to happen when it comes off? Where's the actual true sustainable economic growth within the economy? And I think, so these are the sort of questions around QE. And, so I think I think it's good in the short term for the markets, but the other question to ask is, what's left? The markets have been asking for QE3, they've been asking for this unlimited bond buying in the Eurozone. They've got what they wanted, but what's next? Effectively, what you need is real, substantive economic growth and evidence of recovery. There's not much more that can happen in terms of central banks. I think they've done their bit. What's left is from governments and from real economic growth.
Well, Nick, there's an old saying on the Wall Street that never fight the Fed, and we can talk about, this is short-term gain and long-term pain, but the bottom line here is that those who made bearish arguments this year, they've not made any money. Let's talk stocks, Nick. As a house, you're bullish on LNT and IDFC. Now, LNT is India's biggest construction company. IDFC is in the business of infra lending. At a time when the investment cycle is broken down, what makes you bullish on a infra lender and a infra company?
I think I'd say we're cautiously bullish. I think if you look at what we're looking at the moment, is we're worried that the most effective play recently has been hide in defensives and play multiple expansion. So the classic defences, pharma, consumers have done very well. We think consumer, the kind of this breakdown between the investment cycle and the consumer cycle, the risk is it can break down, and these consumer stocks are priced to perfection. You look in contrast at the stocks related to the investment cycle, and obviously generally they've suffered. LNT's recovered more recently. But I think what we're saying is that if you look at the attention being given to the investment cycle, and the recovery, the real recovery in the market and the breakout of this broad trading range we've seen has to be driven by, I think, the earnings cycle, which will be driven by the investment cycle turning. And so we're saying to catch that early, play quality plays on the investment cycle, and not the higher risk ones, but the quality plays on the investment cycle, because the PMO's office is clearly giving a great deal of attention to trying to drive the investment cycle, reduce project cancellations, and whilst it's early days, it's hard to call that this is actually yet being effective. I think the new finance minister and the coordination between the PM's office and the Planning Commission, for us, those are things that are after the moves yesterday in terms of on the fiscal side. That's probably the biggest area of focus from the government, and hence we're saying, okay, that selectively play that now, but we're not saying there's been any clear evidence yet of a turn in the investment cycle.
Nick, if I talk to fund managers, and the kind of sound bites which I'm picking up from some long-term investors is that they don't like India, they don't want to invest in India because they're worried about the investment climate in India. Do you think this overall pessimism will continue to fuel this market, because it is often believed that bull markets climb a wall of worry?
Yeah, I think the big anomaly for us this year has actually been the discrepancy between, if you look at what SEBI discloses as the FII inflows at $13 billion so far this year, versus what fund managers have been saying to us around the world, where they've moved from a major underweight in December to either neutral or still often, quite a lot of people still slightly underweight. I think the fact that the market's done so well this year will mean people are re-engaging and looking at India, but I think generally we're not seeing a pattern of people saying we want to take more India risk in aggregate, i.e. we're bullish on India macro. What we're seeing is people selectively buying good Indian companies, and you see it if you look at the recent rally since June. It's mostly been in the quality names without obvious issues around governance, stocks that have still had good underlying earnings growth, so private sector banks over public sector banks, the consumer sector, the pharma sector. And I think that's going to continue to be the strategy amongst foreign investors, to stick with what they know and quality names rather than deciding to take on material India risk. I think yesterday's move on the fiscal side is a good thing, but I think people are looking for more than that. They want to see more from the government. They want to see evidence the government can drive above all the investment cycle, that can the Prime Minister's office and the Finance Minister resolve this investment cycle, get project clearances accelerated, because you've had such a sharp deterioration in terms of corporate capex, which has hurt the economy so badly. I think it's things like that that need to turn, and clear evidence of it turning, before you see people taking material India risk and adding weighting to portfolios and increasing weighting to India.
Okay, let me just mark some flashes here. Nifty has appreciated by about 3.5% in last 5 days. So certainly there's a distinct shift in the price action. Now we may call it, it is a short squeeze, this is momentum, this will not sustain. But guess what? The Nifty ticker is currently telling us that Indian markets are marching towards a February high. We look at the list of large cap stocks which are at a multi-year high, and these are good quality companies. TCS, India's biggest IT company. HDFC Limited, India's biggest mortgage company. HUL, India's biggest FMCG company. So this is A quality, good pedigree stuff, the bluest of the blue companies which are now marching towards an all-time high. Similarly, if you look at Chinese markets, at a time when generally we are using the word risk on rather freely, Chinese markets are still at a 3.5-year low. So it's not that global money is coming and global money is chasing all asset classes. Global money is going selectively, and that is an important point. In the light of what's happening to other emerging markets, Indian markets for sure, they are standing out. Nick, let's look at the history of QEs. The QE1 money went into emerging market equities. QE2 money went into commodities. Operation Twist, well, the money went back to US Treasuries and into German bonds. Where do you think the QE3 money will go?
I think it'll follow the pattern of it'll flow into emerging markets generally, but specifically into commodities. I think the biggest beneficiary of QE through all evidence on QE is that commodities are the biggest beneficiary. The problem is we're starting from a high base in terms of commodities, specifically oil at $116, which is bad in terms of for certain emerging markets such as India. And I think the other thing is emerging market currencies will do well out of QE as you see dollar weakness.
So Nick, if a client walks up to you after this interview and his question is, Nick, you know, I've not made any money this year. I've been sitting on sidelines. I've parked my money in German bonds. I've parked my money in US Treasury. But now I want returns. Give me an advice. Give me a stock to buy. What should I buy in India?
Well, the advice would be you've got to move away. You're making the point about the bluest of the blue, which have done well, which I think I agree. And you made the point about TCS. And I'd say you don't play TCS. You play Emphasis. You've got to look for stocks which have had issues. Emphasis has had six or so quarters which have been difficult. And we think that it's being more flexible in terms of its strategy, more flexible on pricing, and hence you're going to see improvements coming through from this quarter onwards in terms of volume growth, and it's trading at 15 times instead of 20 plus times for TCS. And as I mentioned earlier, I think in terms of looking at plays on the investment cycle, the likes of IDFC, the likes of LNT, and then I think in terms of private sector banks, not the HDFCs anymore. We had that at the beginning of this quarter. Our top pick was HDFC, but it's run up beyond our target price now, and I think you have to look for more issues. So still stay with private sector banks, but look for something smaller private sector banks like a federal bank, where you've still got credit growth above the industry. You've got a tailwind in terms of the gold loans, and it's trading at sensible valuations. So I think I talk in terms of portfolio strategy, looking for more issues rather than sticking to the obvious names that have just had a great rally since June.
So Nick, give us some more ideas, because I know you have a lot of buy recommendations when it comes to the mid-cap space as well. What is it that you're advising to your clients at this juncture?
Well, I think the biggest advice we're giving right now, the biggest change in our advice over the last 2 weeks has been to reduce weighting towards the consumer sector. And I think that's important because if you think about the extent of portfolio weighting towards consumer, particularly for foreign investors, has been very substantial, not just in India but across emerging markets, because they've done very well and all the evidence is still that they're doing well. And so our recommendation now is to reduce weightings to the consumer sector, to move underweight in consumer. Now that's important because it's contrarian. Nobody else is saying this, but we're looking at all of the major indicators. You're looking at real wage declines now, difficulties in terms of the job market, declines in terms of consumer sentiment, business sentiment, and you've got consumer stocks are priced, I think the mean is 32 times FY13 earnings, some stocks at 40 times earnings, most stocks trading at the top of their bands in terms of multiples. So it's reduced weighting to that, and I think that's probably the biggest new piece of advice we've been giving. So we've just changed. Our last outstanding buy in the consumer sector was Marica. Yesterday we downgraded that to neutral. So we've now got everything on neutral with the exception of ITC and Nestle, which is on a sell. And we did some interesting work where we looked at the degrees of exposures of different consumer business to different consumer categories. And for example, for Nestle, which you're looking at still near 40 times earnings, actually milk and milk products, if there's a slowdown in consumption, that category is particularly exposed to the slowdown, hence we changed that stance to a sell. So I think that's probably our biggest portfolio decision at the moment.
So when you recommend your clients to get out of consumer names, what is it that you're advising to buy?
So I think if you want to stay defensive, then go for pharma names, where pharma, they're expensive, but at least you don't have the same kind of imminent risks that you have in consumer. In consumer, you've got a risk of both. You can have a slowdown in terms of earnings, but that can then, you get a double whammy when you get a multiple contraction as well. Pharma, it's expensive, you want to hide in defensive, fine, stick with pharma, they don't have any underlying issues, they're good businesses. So likes of Lupin, Sun, Cipla, those sort of names we've been positive on. I think the smaller private sector banks, as I said, I think selectively adding to plays on the investment cycle, as I said earlier, and we had been encouraging people into the mid-cap IT names, but again they've had a really good run recently, and so honestly we do not see as many strong, compelling buy ideas where it's unambiguous and there aren't issues than we were seeing 3 months ago. Because just look at the extent of the rally, and particularly in quality names, particularly in large caps.